It feels like a lifetime ago. Cast your mind back to 2020 and 2021. The world was in a strange place, but the tech and auto industries were buzzing with an energy that felt almost electric. Literally, every week it seemed a new electric vehicle startup was making headlines, promising to disrupt the entire automotive landscape. We weren't just talking about one or two new cars. We were talking about a complete reimagining of what a vehicle could be. These companies weren't just building cars. They were selling a vision of the future, complete with sleek designs, groundbreaking battery tech, and software that would make your smartphone jealous. It was an incredibly exciting time. The investor excitement was off the charts. It felt like a gold rush, where the gold was lithium-ion and the frontier was the open road. Wall Street was pouring billions of dollars into companies that, in many cases, had little more than a cool-looking prototype and a charismatic founder. The narrative was simple and intoxicating. Tesla had proven that an EV startup could take on the giants, and now it was time for the next wave. Rivian, Lucid, Fisker, Canoo, promising everything from rugged adventure trucks to luxurious sedans and futuristic van-like lifestyle vehicles. For consumers and tech enthusiasts, this was the dream we had been waiting for. The monopoly of legacy automakers, who had been slow to embrace the electric transition, was finally being challenged from all sides. The promise wasn't just more electric cars, but better, more innovative ones. We were told to expect vehicles with unprecedented range, lightning-fast charging, and interiors that felt more like mobile living rooms than traditional cars. The hype cycle was in full swing, fueled by slick marketing videos and bold proclamations on social media. It genuinely felt like we were on the cusp of a revolution, where a dozen new brands would flourish, giving us more choice and pushing technology forward faster than ever before. Looking back from today, September 19th, 2025, it's clear that this period was a bubble of pure optimism. The belief was that building a successful car company was primarily a matter of securing enough funding and having a great idea. The hard, grinding, and astronomically expensive work of mass manufacturing was often treated as a secondary detail that would sort itself out later. So, how did all these startups, many without a single car sold, suddenly get access to billions of dollars? The answer lies in a three-letter acronym that dominated financial news for a couple of years. SPAC. A space, or special purpose acquisition company, is essentially a blank check company. It's a shell corporation that has no actual business operations. Its sole purpose is to raise a bunch of money through an initial public offering, and then use that cash to merge with a real private company, thereby taking that private company public without it having to go through the traditional, grueling IPO process. For EV startups, SPACs were the perfect vehicle. No pun intended. The traditional IPO process is long and heavily scrutinized by regulators. You need years of financial records, proven profitability, a rock-solid business plan. Most of these EV companies had none of that. What they had was a compelling story and a massive need for capital to fund their factories and research. A SPAC merger allowed them to bypass the red tape. They could go public based on future projections, bold promises, rather than past performance. This was a game changer. In 2021 alone, EV startups raised an estimated $16 billion, injecting a massive amount of cash into the industry almost overnight. The allure was undeniable. For the founders, it meant faster access to public market money, allowing them to scale up operations at a speed that would have been impossible otherwise. They could pitch their grand visions of future revenue and market share directly to investors who were hungry for the next Tesla. Lucid Motors, Fisker, Canoo, Lordstown Motors, Nikola all used this method to go public, seeing their valuations soar into the tens of billions of dollars before they had even delivered a significant number of vehicles. This financial shortcut, however, came with a hidden cost. The reduced scrutiny meant that business plans that were, to put it mildly, overly optimistic could be presented as near certainties. The focus was on the sizzle, not the steak. Companies were valued based on ambitious PowerPoint presentations and computer-generated renders, rather than their ability to actually manufacture complex machines at scale. This created a fragile foundation built on hype and future promises. When the time came to deliver on those promises, the entire structure began to wobble, setting the stage for the painful correction that was to follow. By 2022, the music began to slow down. The initial euphoria of going public started to fade, replaced by the harsh, unforgiving realities of automotive manufacturing. Promises made in boardrooms collided with the physics of the factory floor. The first and most public casualty of this reality check was Fisker. The company relied on an asset-light model, outsourcing manufacturing to Magna Steyr. It ran into severe software issues. It faced quality control problems. It suffered logistical nightmares. After delivering only a fraction of projected vehicles and burning through cash at an alarming rate, Fisker filed for bankruptcy in 2024, leaving disappointed customers and worthless stock. Then there was Lucid Motors, positioned as a direct competitor to the Tesla Model S. The Lucid Air was genuinely impressive, winning awards for its incredible range and luxurious design, but a great product was only half the battle. The company consistently struggled with what they called production hell. They repeatedly slashed their production targets, citing supply chain bottlenecks and manufacturing challenges. Despite raising billions, they couldn't build cars fast enough to meet demand or justify their sky-high valuation. The pain was widespread. Rivian, after one of the most successful traditional IPOs, wasn't immune. The company struggled to ramp up production of its R1T truck and R1S SUV and control costs. Its stock fell from over $170 to under $20. A staggering loss of value. Canoo, with a unique skateboard platform and a subscription-based model, faced a similar fate. Canoo burned through its SPAC cash, underwent management shakeups, and repeatedly warned investors it might not have enough money to stay in business, causing its stock to become nearly worthless. What we all learned is that making cars is incredibly hard. It's a business of tight margins, complex supply chains involving thousands of parts, and immense capital expenditure. It requires a level of manufacturing expertise you can't buy with SPAC money. Startups discovered what legacy automakers have known for a century. Building a handful of beautiful prototypes is one thing, but churning out tens of thousands of high-quality, reliable vehicles per year is a different challenge. The reality check was brutal, and it separated the companies that could actually build from those that could only dream. The struggles of these EV startups weren't just a series of isolated incidents. They were symptoms of a perfect storm of challenges that hit the industry all at once. The first and most fundamental problem was over-promising and under-delivering. In the race to attract SPAC funding, founders made incredibly bold projections about production numbers, technology breakthroughs, and profitability timelines that were nearly impossible to achieve. They were selling a vision of being the next Tesla in 2 years, when in reality, Tesla itself took over a decade of struggle to become sustainably profitable. A second major factor was the sheer rate of cash burn. Building factories, sourcing materials like lithium and cobalt, hiring thousands of engineers and factory workers. It all costs a staggering amount of money. These companies were burning through hundreds of millions, sometimes billions of dollars per year long before they were generating any significant revenue. The SPAC money, which once seemed like an infinite war chest, started to look dangerously finite. As interest rates rose in 2022 and 2023, it became much harder and more expensive to raise additional capital. The easy money dried up, and companies without a clear path to profitability found themselves in a precarious financial position. Then came the competition. Ford launched the F-150 Lightning and Mustang Mach-E. GM rolled out its Ultium platform with vehicles like the Cadillac Lyriq and Chevy Blazer EV. Hyundai and Kia delivered a knockout punch with their eGMP platform, think Ioniq 5 and EV6. These legacy automakers had deep pockets, established supply chains, and a century of manufacturing experience. Suddenly, the startups weren't just competing with each other, they were competing with global behemoths who could leverage their scale to produce EVs more efficiently and at lower prices. And of course, there was Tesla. Throughout this entire period, Tesla wasn't standing still. It was expanding its gigafactories, cutting prices, and solidifying its dominance in the market. Tesla's brand loyalty, supercharger network, and manufacturing efficiency created a massive competitive moat that proved incredibly difficult for any startup to cross. As the dust begins to settle in 2025, the EV startup landscape looks vastly different than it did just a few years ago. The field has been thinned dramatically, but it's not entirely empty. A few key players have managed to weather the storm and emerge, while bruised, still standing. Rivian is perhaps the most prominent survivor. Despite its stock market woes, the company has successfully ramped up production of its R1T and R1S vehicles to respectable levels. They secured a crucial partnership with Amazon for their electric delivery vans, providing a stable stream of revenue. Most importantly, they revealed their smaller, more affordable R2 and R3 platforms, showing a clear roadmap for future growth and a path toward profitability. Lucid, while still facing significant challenges, also remains in the game. Their survival has been largely underwritten by the deep pockets of Saudi Arabia's public investment fund, which owns a majority stake in the company. This financial backing has given them a lifeline that other startups simply didn't have, allowing them to continue refining their manufacturing processes and developing future models, like their Gravity SUV. Their ability to survive long-term will depend on whether they can finally solve their production scaling issues and translate their luxury brand into sustainable sales volumes. But for now, they are still a contender. it's also important to look beyond the SPAC-funded companies. While they dominated the headlines, other EV makers took a more traditional and ultimately more successful path. Polestar, the electric performance brand spun out of Volvo and owned by Geely, has steadily grown its presence globally. By leveraging its parent company's manufacturing expertise and supply chains, Polestar avoided many of the production pitfalls that plagued the SPAC startups. They took a slower, more deliberate approach to growth, building a solid brand reputation for design and quality. Their success serves as a powerful counter-narrative to the get-rich-quick mentality of the SPAC era. Another quiet success story is VinFast, the Vietnamese automaker. While they also had a volatile public debut, their strategy has been one of aggressive global expansion backed by the financial might of their parent conglomerate, Vingroup. They've established a presence in North America and Europe, and are building a factory in the United States. While their initial vehicle quality received mixed reviews, their persistence and financial staying power demonstrate a different model for market entry. The survivors are those who either had a uniquely compelling product and a clear path to scale, like Rivian, or were backed by immense patient capital, like Lucid, Polestar, and VinFast. The collapse of so many EV startups might sound like bad news for consumers. After all, doesn't more competition mean more choice and better prices? In the short term, maybe, but in the long run, this industry consolidation is actually a very good thing for anyone who wants to buy an electric car. Think about it. A market flooded with dozens of fledgling companies, many of which are financially unstable, creates a lot of uncertainty for buyers. Would you feel comfortable spending $70,000 on a car from a company that might not exist in 2 years? What happens when you need a software update, a replacement part, a warranty repair? The failure of companies like Fisker serves as a stark warning. Owners were left with vehicles that had unresolved software bugs, and the terrifying prospect of having no service centers or spare parts available. A healthy market needs companies with staying power, brands that you can trust to be there for the 10 or 15-year lifespan of a vehicle. A smaller number of stronger, more financially stable companies means that when you buy a car, you're also buying peace of mind. You can be confident the company will continue to support the vehicle with updates, service, and parts for years to come. Furthermore, this shakeout forces the surviving companies to be better. When the easy investor money disappeared, the only way to survive was to build a genuinely good product and a sustainable business. The companies that remain, like Rivian, Lucid, Polestar, and the legacy giants, are the ones that have proven they can handle the complexities of manufacturing. This means overall quality, reliability, and user experience of EVs on the market are likely to improve. The focus shifts from flashy marketing and bold promises to what actually matters to owners: build quality, software stability, and a reliable charging experience. Ultimately, this consolidation leads to a more mature and robust market. Instead of a chaotic free-for-all, we're now seeing a landscape of serious, committed players. This healthy competition will still drive innovation and keep prices in check, but grounded in reality, not hype. For you, the buyer, this means choices from companies that have been battle-tested. You'll be choosing between brands that have proven they can design a great car, build it, sell it, and support it for the long haul. That's a far better position for consumers to be in. So, what does the future hold for the survivors who are still finding their footing, like Rivian and Lucid? Their journey is far from over, and the next few years will be just as critical as the last. For Rivian, the key is executing its R2 strategy and the R3 strategy. The R1 series proved they could build desirable, high-performance vehicles, but those were expensive niche products. The smaller, more affordable R2 is their ticket to the mass market, competing with the Tesla Model Y and the Hyundai Ioniq 5. If they can manufacture the R2 at scale and at a profit, Rivian has a real shot at becoming a major, enduring automaker. For Lucid, the path is a bit different. They seem committed to the high luxury market and to high performance, positioning themselves as an electric equivalent to Mercedes-Benz or Porsche. The upcoming Gravity SUV will be a crucial test. Can they expand appeal beyond the niche sedan market? But they face continued production struggles, an immense cash burn, which raises the question, standalone company or acquisition? It's easy to imagine a legacy luxury automaker acquiring Lucid, a merger with Aston Martin, or another established luxury brand. That could provide the manufacturing scale and stability Lucid needs. Mergers and acquisitions will likely dominate the coming years. The EV gold rush created valuable technology and intellectual property. Established automakers might acquire the remnants of failed startups to grab battery tech, or unique platform designs, or talented engineering teams. Take Canoo's modular skateboard platform as an example. Despite financial troubles, it's a clever piece of engineering, and valuable to companies focused on commercial vehicles or delivery services. The assets of the fallen won't just disappear, they'll be absorbed and repurposed by the winners. The survivors themselves might also look to consolidate. We could see partnerships or full mergers between EV-native companies to better compete with Tesla, Ford, and GM. The road ahead will demand relentless operational efficiency, cost reduction, and smart strategic moves. The era of limitless funding is over. Survival now depends on smart business fundamentals. Whether they make it on their own, get acquired, or merge with a competitor, the next chapter for these once-hyped startups will be written on the factory floor and in their financial statements. The story of the EV boom and bust between 2020 and 2025 will be studied for decades. It stands as a powerful cautionary tale about the dangers of hype, the allure of financial shortcuts, and the timeless, brutal difficulty of making things in the real world. It reminds us that innovation is about more than just a brilliant idea. It's about execution. The SPAC craze created a collective delusion that building a car company was as simple as developing an app. It wasn't. This period taught a new generation of investors and entrepreneurs a very old lesson. Manufacturing is hard, and there are no shortcuts to building a sustainable, profitable business. However, it would be a mistake to view this entire episode as a failure. While many companies faltered, intense competition and massive injection of capital fundamentally accelerated the automotive industry's transition to electric. The pressure from these startups forced legacy automakers to get serious about their EV strategies much faster. The innovation in battery technology, software, and vehicle design that emerged during this period pushed the entire industry forward. The market is now a more vibrant and competitive place because of that ambition, and even the failures served a purpose. This period has also made the EV market smarter. Investors are now far more discerning, looking for proven manufacturing capability and a clear path to profitability, not just a slick render or a bold proclamation. Consumers are more educated, understanding the importance of brand reliability, software support, and service infrastructure, and the surviving companies are stronger and more resilient, having been forged in the fires of production hell and financial scarcity. The market is maturing, moving from its speculative Wild West phase into a more stable and sustainable era. What remains is a smaller but more robust group of companies prepared for the long haul. Ultimately, the story of the EV gold rush is a classic tale of technological disruption, messy, volatile, and full of both spectacular successes and dramatic flameouts. It's a reminder that progress isn't a straight line. For the future of electric cars, this painful shakeout was not the end of the dream, but a necessary correction. It cleared away the froth and left behind a stronger foundation upon which the next stage of the EV revolution can be built. The road to an all-electric future is a long one, and this chapter, for all its turmoil, was an important and unforgettable part of the journey.